Tick-tock, welcome back. Now there seems to be a theory out there that is supported by Harry S. Dent, genius, that says that we are tracking the 1920s bull market, and there seems to be anything from an 80.5 to 81.5 year lag. You just take what happened in the bull market in the 20s, add anywhere from 80.5 years to 81.5 years, that's 1 year give or take, and you're gonna find that it corresponds to today's market going back to 2000. Now the theory has been out there for almost 10 years. Now if you don't know, now you know. This is the kind of stuff that is just made out of pure brilliance, and what I'm gonna show you in this video is that there is validity to that. What I have in front of you right now is, if I can take my I have the chart of the Dow Jones Industrial Average going back to 1920 all the way. It's a huge chart, all the way, if I can show that, all the way to 1934. The current market starting in 2000, and it is what you see right now in front of your screen, and I've taken and I have compared that market with the market in 19. Right here is 1920, and this is Dow currently. Let me push that down a little bit, and this is Dow in 2000. So 1920 and Dow 2000, and I've just moved them by by 1 year forward. So in other words, we have an 81 year lag, and what you find that is that after this peak in the late 1910s, after this peak in 1919 or 1920, there was a steep drop. There was a steep drop in the market right here, and you can see there's a steep drop in the market, and you see the same thing when the Dow hit its 2000 highs. There was this steep drop, and then you see this fast wave, the fast drop right here around late 1920 corresponds to the drop of the Dow in this red line. The red line is the Dow year to date from 2000. So the red line corresponds to that drop right there, almost on cue. And then we have this mini rally in the 2000s, we have this mini rally in the 1920s, and then we dropped again. Here, and we made a low right there. You see this low is that corresponds to the mid 1921 drop, corresponds perfectly. And then we had a bear market rally right there in the 20s. We had a bear market rally sometime in 2002, and then we dropped and made all-time decade lows in October, I think sometime in October 2002. Now that corresponds exactly to the 81 years later, to the 1921 drop to new all-time lows in 1921. So we get these two waves here, 3 waves down, all-time decade lows right there, they correspond perfectly. Okay, and then we have this, so we start moving up from this low. We make this attempt, just like we made this attempt to break this all-time highs, and we also had that. We're almost doing the same thing right here. We were attempted on several occasions to close above that line, but we never really managed to do that. So what we did manage to do is that, you see, after a lot of years, we finally managed to kiss that high, and we kissed that high right there. And then we had this drop, which is looks to me like I noted in my introduction, that there was this nice looking, great looking cap and handle, and then we had that right there, bang, to new highs. Okay, that's in the 1920s. So come back to recent history, we got this nice similar looking right there, and then we have that breakout, bang, to new highs. Okay, so that's a given. It's right there, it's in front of you. So now what happened? So now let me remove those. So what you see around last year in October, I posted a note. Let me show you what I wrote. I said we are in the 6th day of August last year. I said this sell-off is about, because I knew that we were right there based on the 1920s low. I knew we were right here at the time, and I said this sell-off is about to end just as it did in October 1924 if you assume an 80.5 to 81.5 year lag. I say quadruple buy. Buy. Okay? And you see what's happening is that since then, second, I'm gonna scroll up. Since then, we've had this steep raise in the Dow. Okay, the Dow moves right. This is the red line is the Dow recently. So from October last year, we went up straight and made a high sometime in early February, and you can see it corresponds with this raise right here. Makes a high in February. We have a drop, in short-lived drop in February, and a move back up to new highs. 80 years ago, we had the same thing. We dipped down a little bit and then made another attempt to new highs. It's the same attempt right here, and then now we have the subprime sell-off right there, and corresponds to that low, around that low, based on the 1920s action. So what I'm saying, this low and this low correspond to me. This is another quadruple buy, because this is definitely signaling that we have reached a short-term low. Folks, you go out there and buy all the stocks you can find. Be selective as always, because what we are gonna see now after we hit these lows, we are gonna see either some little bit of up and down action, but obviously we're gonna be back to new highs very soon. By the end of the year or early 2008, we are gonna be moving to new highs. You watch out for this. Watch the tape, and you can see what's gonna happen towards 20, somewhere around here. I'm telling you, by the time we get to 2011, we are gonna see a Dow 25K. All right, and that's a conservative price target. Guys, we are tracking the market going back all the way to the period when the Model T was out there. So I'm telling you, you go out there, find as many stocks that look good to you, because we are right here. You see that the red is the Dow. We are right here. We just made a low right now, and what is left for the rest of the decade is this nice rally to new mega all-time highs. Of course, we're gonna have a little short-lived bear markets along the way, but as far as I'm concerned, again, Dow 25,000 locked and loaded. This is ERIC going out to my man Jack Stewart. What's up, Colorado? Yeah.